Sonal Verma joining us this morning, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura. Pankaj Srivastav, Senior Vice President at Rystad Energy, also joining in. Welcome to both of you. Thank you so much for your time to us here on the India Market Open. Sonal, I'm going to start with just understanding how bad this can get from an Indian perspective.
Yeah, hi. I think, the exposure for India is quite high on various counts. We import more than 85% of our crude oil needs. Nearly half of this actually comes from Middle East. And we're not just talking crude oil, but the dependence on, LNG, LPG. And then, the dependence on the Strait of Hormuz for a lot of this crude that comes through. So I think, the challenge right now is that the increase in oil prices is no longer just restricted to an increase in oil prices. It has spread into sort of other derivatives. We've seen an increase in gas prices, petroleum product prices, fertilizer, is also a risk because that also passes through the Strait of Hormuz. So we are sort of seeing the ripple effects across the energy supply chain. And the uncertainty right now is on the duration of this shock. So for a net, oil and energy importer like India, this is a negative terms of trade shock. Typically, these kind of shocks tend to be stagflationary in nature. It leads to higher inflation and lower growth. If it's a short-term issue, then it could be managed. If it's longer term, if it's multi-month, even in that scenario, there will be, economic and other challenges. So that's the context, for this, from India's perspective.
We'll delve a little deeper into some of those issues. But Pankaj, I want to come to you on whether an alternative can be found. And already prior to this conflagration, you had issues with the Suez Canal and with regard to Yemen, right? And now you have the Strait of Hormuz getting affected. So therefore, the question to you is, oil prices at 82 or thereabouts for Brent, and Donald Trump coming in and stating that the US will facilitate trade, maritime trade of oil. Does that work? Or are we seeing a potential increase in crude prices to $100 in the near term?
Yeah, there's a couple of things we have to consider before we arrive at any conclusion. Historically, also, never the Strait of Hormuz has been stopped, and Iran kept on issuing the threats. But this time, this has been realized. And the alternate route through Red Sea can be utilized, but couple of things which India can consider as far as the crude prices are concerned. One thing is, if you have seen with the Venezuela coming online, India has started importing significant amount of the Venezuelan crude. And along with that, I expect that a lot of crudes will start coming from the US also. Because the refineries, Indian refineries are designed for a crude, which is the medium sour crude. And before this conflict, our reliance on the Russian crude was significantly higher, almost more than 50% crude is coming from there. And then because of the sanctions and the US pressure, we moved to the Middle Eastern crudes, and the percentage has risen close to 50%. It is a replacement from the Russian crude to the Middle Eastern crude. But now the situation is a little bit different. Couple of options which India can exercise, but that is dependent upon the time frame. We also need to consider that every refinery, even if the Indian strategic petroleum reserves are there, so there should not be any worry as far as the feedstock supply is concerned. Between 30 days, 25 to 30 days, every refinery will have close to 15 to 20 days of the storage so that they can run without any disruptions. But if the things goes beyond that, then we will have a problem. Option one, India will start relying more on the South American countries like the Brazil, the Guianas. These countries have significantly increased their crude production. And then obviously one of the source can be the US. We may see some WTI flow into US, into India, but the problem is that US WTI crude API is quite high, and we need to blend it with the heavy crude. So for my expectation is another 3 weeks, even if the Strait of Hormuz is closed, we will not see the supply crunch. Yes, the crude prices are going to increase, but because of the conflicting statements coming from the Iran and US and the overall pressure from the global community, we will not see very steep rise at least for a couple of weeks
Got it.
till the crisis is really hard.
Perfect. Pankaj, wanted that particular perspective, and thank you so much for sharing it with us today. And well, wishing you and yours peace and serenity over the next few days. Thanks for being with us today. Sonal, I'll bring the conversation back to you, and that was an important point made by Pankaj. But here's the question, right? If this continues, and you said that if this were to be prolonged, there could be repercussions. Could you dwell into that a bit?
Yeah, so I think, number one, India is one of the most exposed to this shock. But I think the second aspect to keep in mind is that we do have some buffers in place, particularly on the fiscal side. So the oil marketing companies are still in the positive in terms of the marketing margins on both petrol and diesel right now. And on our estimates, once Brent starts moving beyond $85 per barrel on a sustained basis, that is when their profitability basically, the margins basically go from zero to negative and it becomes a crunch. So I think, the fiscal, in a sense, sort of becomes the first line of defense, whether it's off budget via the oil marketing companies or on budget. So we do think the government initially will continue to protect consumers by keeping pump prices unchanged, and the hit will be more on OMCs to begin with. And if this sustains over a period of time, then the price impact will be visible on consumers. So if that is the case, I think the inflationary consequences can be mitigated at the consumer level for now. But the impact on India's current account will nevertheless be there. So every 10% increase in oil price worsens the current account deficit by about 0.4% of GDP. So FY26, will end up with a current account deficit of less than 1% of GDP. But if prices sustain at 80, for instance, then we easily get slightly above 1.5% of GDP in the next 12 months. So funding that will become a challenge in the global environment we are in. So I think the bigger macro impact right now is really more on the balance of payment funding side. We have buffers to minimize and mitigate the negative impact on inflation and growth right now, because fiscal impact, I think, will actually come in at the first stage.
Important point there to note. So balance of payments, something to watch out for. Sonal, I'm wondering if the only or one of the only bright spots here or positives that you can take is that inflation largely has been subdued, and to that extent the impact might be softer perhaps. In another scenario where you were talking about $85 to the barrel, it would have been significantly higher. Is that the right way to look at it?
Yes, I think, if you recall, in the older CPI series, every 10% oil price change typically translates to around 35 basis point upside on CPI inflation. Under the new CPI series, actually the weights have changed, and the weight of some of these fuel components has actually increased. So the same sensitivity, which used to be 35 basis point, has moved up to almost 50 basis point. But if we do have, fiscal policies sort of acting as a wedge and preventing the pass through of these prices at the pump level, I think the inflationary impact in terms of petrol, diesel prices will not be there. But if you are a manufacturer, who depends on, gas or some of the other intermediates, but, imported, then there will still be some increase in your cost of production. And if demand in that particular sector is not very strong, then there could be some margin pressure for companies, even though we don't see an inflationary impact at the consumer level. So I think the question is, how long this is going to last in terms of the duration. If it's a big spike, but if it's just a 1 month, increase, then there are buffers to actually manage and, bridge to the other side. But if it extends beyond a month and we start running out of inventory, then it's not just a price impact, but also the volume impact because of the supply crunch. And I think the impact of that, like across the supply chain, will be there because energy at the end of the day is the foundation of how an economy functions.
Yeah, fair. Sonal, thanks so much for taking the time. Important to speak with you this morning. Pleasure as always.